All right. Good evening, everybody. What is going on? Thank you.
And it goes without saying, his name is Steven.
If anybody is watching the UFC event right now, I don't know how to pronounce this guy's last name, but Zao or whatever his name is should be thrown out of the UFC. Should never be allowed to fight again. 3 groin strikes within a minute and a half.
Oh,
ridiculous!
No bueno.
Ridiculous.
I was like, what is he doing? But
oh my god!
Yeah, you don't.
I can't believe they're going to let this fight go on. Herb Dean has just taken 2 points in the past minute.
That's no bueno. I'll let a lot of things slide, but
craziness. What is going on, everybody? All right, so
great day, Steve. Able to hang out with you and everybody in the chat. It's gonna be a good time.
I know that I had a few things in the title, but I want to start off with something a little different before we get to those things. And Matt, before we do, what type of cigar did you smoke?
I sent you pictures.
I know, but I need to hear it.
It was something from the Oz family, and I had never seen that before. So a little sugary pick-me-up, Steven?
I just wanted one.
I don't blame you.
I just wanted one.
I have to drink the 0 sugar these days, but yeah, I'd never seen it before. It's the Ozoner family. No, Oz Jenner family. Oz Jenner family cigar, and I smoked the Caratoba. And I'm going to be honest with you, Steve. I have not had I don't know. I was looking for something new, something I hadn't smoked before, and that was it, and I liked it.
Tommy Dimes, Partagas.
You're still my viewer, Steve. Tommy is a long-time Matt Money.
Tommy and I were the same cloth, all right?
Why is that? What does that mean?
Listen, if you go to his Twitter account, you'll know why.
Okay.
If you go to his Twitter account, you will know why.
Steve, did you have the opportunity to see the thumbnail?
I did see the thumbnail.
What did you think?
I thought it was good. You never seemed to amaze. You never seemed to disappoint. You know what? Your thumbnails are amazing.
Are you gonna give your audience a little sneak peek? Because a lot of them go to your channel. I'm not trying to be mean. A lot of them go to your channel. They didn't see it.
So. Yeah, we can download and we can. I don't have to download. Your number doesn't show up. Perfect.
Oh, it doesn't? Good.
Well, I'm just making sure before I freaking double checking.
I appreciate that. I don't need a bunch of texts being like, Matt, what you think VG happened Monday? I'm like, dude, I'd probably going to 0.
So I guess I'm driving Matt to work.
You're not driving me. You had your chauffeur come and get me.
You know what I mean.
Yeah.
Hilarious. So Matt, I spent the better part of the afternoon watching a lot of videos about a lot of things and doing a lot of research. I'm annoyed.
First and foremost, I appreciate that you are better than me. Second, and probably most importantly, is that a Burberry scarf on the couch back there?
I have no idea what you're talking about.
Thirdly,
I have no idea what you're talking about.
Steve, thirdly, do you need a driver? For anybody listening only and not being able to see, the graphic was, as I eloquently put it, me being chauffeured in Steve's limousine Rolls Royce. Steve looks phenomenal as always, with a 3-piece suit, a pinpoint white, tie, obviously smoking a delicious cigar, which is obviously AI because Steve has given that habit up. But he's got champagne in the cup holder, and I am washed up with a cardboard sign basically looking for work because Steve is better than me. And there you go. But thirdly or fourthly, did you get your second article of the day done?
I started it. I didn't finish
Is that
it.
what that was occupied by watching the?
Well, that was occupied by going down a rabbit hole about retirement. And before we talk about it, disclaimer: we're not financial advisors. Please do your own due diligence. We have no idea what your situation is. Please use common sense. Please seek professional advice. Thank you very much.
I don't know what my own situation is, Steve. You reminded me this morning. You were like, if I had your money.
Well, I don't know what my situation is either, but I watched a video that was deeply disturbing, and I pulled some statistics. Are you ready for this?
Generally, when you go into this sort of excitement, you make a lot of sense. So I'm very excited for this next segment.
Well, we're going to talk very briefly about U.S. retirement savings because something needs to be figured out. So, based on public data that I found in the age brackets, okay?
Yeah.
Around age 30. So, this is the 25 to 34 band. So, we're going to call this the 30-year-old, the 30s, early 30s. The average, $37,000.
For 37-year-olds?
25 to 34.
Okay.
37,000, and the median 15,000. Around 40, which is ages 35 to 44. 91,000 average, 36,000 median. Around 50, ages 45 to 54. The average is 168,000. The median is 61,000. Around the age of 60, okay? 60 years old. The average is 245,000 and the median is 88,000. Now, the reason why
that's above 65 or below?
No, around 65, around 60, so 55 to 64. Now, 65 plus, 273,000 average, 88,000 median. Why this is so depressing is because the average is so much higher because of the very large accounts. So
people
you
like
look
you,
at the
Steve.
median, and this is crazy. I mean, it is really shocking. And I swear to God, and we talked about with Vlad, we need such strong levels of financial literacy that I don't even know what to do anymore. This is really, and I knew the numbers were like this, but it's something else after watching two of the videos I watched and doing the research on it. I'm freaking annoyed. I really am, because we need to do better as a society. We need to do better as a country. And I really think we need to reform the entire education system. I really
no,
do.
I'm 100% aligned. This goes back to the holiday time when you and I were chatting about the Trump accounts, and I am very very for this, and this is probably why, if I do get into money management, one of the reasons why I would is because I'm not just looking for, and this is why, I don't preach, hey, and I know part of my persona here is, finding Rocket Lab and Palantir and stuff like that, but really I've been a huge advocate for people just putting their feet into the market and just buying the S&P 500, or just getting themselves in a cadence where you make millionaire sort of decisions, right? Having that millionaire mindset. And that millionaire mindset isn't finding the best stock. That millionaire mindset is running your life like a business and making sure that you have ample savings and you're reinvesting in yourself and in your future. It's disheartening for me to see me having multiples in my retirement account. And keep in mind, I don't actually invest a lot in my retirement accounts. I mostly do individual brokerage accounts, but because I have a strict plan that I thought would work, and it has panned out well for me. But it just goes to show you that there's such a window for re-education, like you stated, and the comfort around money and making sure that people are entrepreneurial in this country has been absolutely sideswiped over the last several generations. And that's why when watching your podcast with Basis Points, and if you haven't, please go and watch the interview with Vlad. It excites me so much, even from not just a potential investment and the fact that they're going to continue to capture market share, but they're thinking about the long term and mentality and social aspect of making sure that the future generations are covered as well. And that's part of the reasons why I think BM&R is great as well. They're thinking about partnering with Mr. Beast and getting that younger generation fired up about investing and making it not as faux pas, talking about it at the dinner table. And this number, I've been watching it for a decade, Steve, and it hasn't gotten better. These numbers aren't too dissimilar to when I've looked at it myself in the past. It's been years since I have, but it's no different. And unless you see a fundamental shift in, like you stated, the average American, it's going to be very tough.
Yeah, my problem is we need to, my opinion, and I may not be right. I would much rather the younger children learn about debt, learn about saving, learn about compounding. And I do think that them owning a piece of the 500 greatest companies in the country makes them incentivized to understand and get in that mindset that they're owners in these businesses. It is absolutely crazy to think that $125 a week, starting at 21 years old, okay, at a 10% rate of return. I'm sorry, $125 a month, not a week, can turn into over $1 million. $125 a week. And I know in the beginning that's really hard. I get it. But trust me, I get it.
Huge.
At the same time, even just putting $50 a month in, $75 a month in to start, $40 a month, opening these accounts when you're 18 to 21 is so important. And look, I have an undergrad in economics, okay? I have an MBA. None of that shit means anything. You get a better education on YouTube if you watch the right things. I firmly believe that. I'll take on the whole entire education system. I'll debate any college professor. I'm saying it live. I really, truly believe that. And the amount of money that college costs these days is a sin. Allowing these people to come out of college with hundreds of thousands of dollars in debt, and there is no way for them to pay that off in a timely fashion that doesn't allow them just to accumulate more debt is crazy. Like, I get so aggravated by this, and seeing these statistics about the median for retirement, I don't get it. I truly don't understand why we are focusing on things that people thought were important back in the 50s and 60s. It's crazy to me. It's crazy. Financial literacy should be, and Vlad changed my mind on this. I said it should be core curriculum in high school. He said grade school. And the more I think about it, if we can make math a core curriculum in grade school, sure, let's do financial literacy. 100%.
We did one quarter or something like that in 8th grade, and then we did another. But I think you're right, Steve. I think it should be something that's at least 5%, 10% of the curriculum, because it spills into everything else that we do. The businesses that we work for, they're all living entities, and it shouldn't be controlled by, the mentality of it, right? And I think it's the mentality of the owners and the businesses themselves shouldn't be limited to the education of a select few. Everyone should have that education to be able to manage. And maybe maybe some people are going to be better at it than others, but at least they should have the capability to, if needed, be put in charge of some of these companies. And I think we would be better off as a society for it. The other piece, it's crazy that you bring this up. I was not expecting this. The thought that I had initially was actually today, when I was getting ready and showering and about to go to the cigar shop, was literally just this. Like, maybe I actually go to schools and actually talk about some of these things and consult and help people. And it's crazy that you bring this up, because this is completely unscripted. We didn't talk about this at all.
No.
But I guess it was inspired by the conversation you guys had yesterday with Vlad, right? With the young accounts, etc. So or I guess 2 days ago with Vlad. But before you chime back in, um, going back to the 401k contributions, and I get it, it's tough. There's so many other things, to spend money on that you can get gratification today. I get it. But it's like a muscle, right? Everything is like a muscle. You start at $50, like Steve said, a month. And eventually you'll realize, oh, I have this excess money. If it's about getting started. The first point is about putting that first $50 in that month. And then the battle is incrementally easier after that. I promise you, you'll be able to see, hey, I was able to live without that $50 a month. Maybe I can up it to 100. And then it's a personal game of discipline, being able to say, you know what, I am doing better for myself. I am focused on my future. And maybe it's easy for me to say, Steve, because it's a hobby of mine. But man, like, I think I was there. I did it myself. I started at zero. I was able to do it 10 years ago, 12 years ago. And it gets easier with time as long as you're continuing to keep your eyes on your money. And money goes where attention goes. So if you just give it just a little bit, whereas most people don't give it anything at all. But if you just give it just a little bit, they'll be further off than they would have been by light years had they just not even thought about it at all.
So I am reading the comments, and I saw one of them that was kind of making a crack about my comment about being able to get a better education on YouTube than actually in grad program. Well, it depends. I'm not talking about accounting per se. I'm not talking about becoming a lawyer, but I promise you can learn how to run a business better watching, if I gave you 3 videos, than going through an entire MBA program. I promise you can learn how to run a business much better. I've been through it.
There's a reason why I haven't gotten an MBA, Steve. I initially, growing up, was like, I'm getting an MBA. I met several people in my business and throughout that I've met that have had MBAs, and I'm like, I'm smarter with money than they are. So what's the point of me going?
It's one of those things. I feel super passionate about it. And the bigger thing is we have to get away from idolizing consumption. And I think a lot of people just waste money that they can let work for them on stupid things. But we're going to move on. I'm going to go really deep on a video about this. So we have a special guest coming on also that's going to join us in a few minutes. So we're going to warm it up and first talk about oil going past 90, which I wasn't sure if it was going to do, Maddie. How you feeling about that?
Senor. There you go. Okay. But no, I mean, we talked about this, Steve. I mean, when this skirmish broke out over a week ago, we were talking, do we think it's going to go above $80-$85 a barrel? And, at that time, it seemed like, and, maybe it was my bias, but at the time, it seemed like it was going to be rather quick, and maybe because Ayatollah had already been kind of taken over, and unfortunately, well, not unfortunately, but sorry, how am I trying to word this? Ayatollah had been taken out, right? And so I thought it was going to be more swift than it has been, and unfortunately, it has not been. But as most conflicts, right? It's going to potentially drag on. And I was just listening to the comments of Trump coming back from the first few bodies, unfortunately, that have lost their lives. He was in Dover, I think, going and walking some of the transfers of the bodies to their families before they get buried. And he strictly said, he's like, this might go on longer than I initially was expecting. So that being stated, and in the other countries being involved, which now I think Iran has stated they will no longer attack other countries in the Middle East other than specifically the United States and maybe the bases, that might alleviate some of these things. But still, as we talked about that evening when we were talking about oil and natural gas prices, liquefied natural gas prices, Strait of Hormuz continues to be closed. Very few people or ships are able to go through it. There have been some Chinese ships that have been able to pass through it, but it's progressed longer. And now a lot of these countries have started to shut in, specifically Qatar and many others have started to shut in their production because they've run out of storage, and as well as LNG, they've shut the LNG facilities in Qatar, which provide a lot of the energy for Southeast Asia. Sorry.
Did you see that Qatar's energy minister warned the Financial Times that Gulf energy exporters could be forced to shut down production within weeks, and it could potentially push oil to 150?
I did not see that piece, but I know that they shut their LNG facilities, and it's going to take those things take a long time to pressurize and get started up. So it's all.
So, Chris, I know that
issue.
you've spoke about stagflation in the past. What are you seeing right now?
I mean, the environment definitely supports some level of stagflation, but I think there's a bunch of disinflationary pressures that are also building. So I'm not sure that we see the crazy level of stagflation unless oil prices and energy prices stay higher for longer than maybe like 30 days. I think 30, maybe 60 days is what the market can tolerate before you start to see the forward curve start to really pick up, right? So what ends up happening is right now, if you look at the curve on oil and natural gas, you're seeing the front months. Of course, these, the next couple of months, the prices have gone up significantly, but the back end of the curve has not gone up nearly as much, right? So for people here watching, so what happens is when you have any sort of commodity, you have contracts that kind of get negotiated between suppliers and from producers, right? And so it's almost like, hey, I need to buy oil next month. I need to buy 5 million barrels of oil. And there's someone out there that's producing oil that says, hey, I can deliver 5 million barrels of oil. If you can guarantee me a price at $70, I'm more than happy to pump the oil to make sure that I have demand. And the guy who needs it says, I'm happy to pay $70. Now, let's say an issue like this comes up in the price of oil because the guy that's producing that, 5 million barrels of oil, he can't produce this anymore. Now, all of a sudden, you have to go and you have to buy it from someone else. And someone else might say, hey, listen, I've got 5 million barrels of oil, but I'm not going to sell it to you for 70. I'm going to sell it to you for 90, right? So what happens is a lot of companies, in order to avoid these disruptions to their business models, they buy contracts into the future. So what ends up happening is right now there's uncertainty for the next 60 to 90 days. So people are saying, oh, I better load up on my, contracts right now to get the best price possible. So, people who are smart, they bought contracts in the 70s and 80s, even though oil was trading at $60 a month ago, because they were just like, we need to be careful. We need to hedge. Now, there's people that waited. Now they're like, oh, I better buy these $80 futures contracts because it might be $100 next week. And then you got the people that waited longer than that. And they're like, shit, I better buy the $100 ones because the next week might be $180. So everyone is just buying these forward contracts. But the thing is, I'm looking at the demand going further out, like 9 months and 12 months. And so there's been a pickup in prices, but it hasn't nearly been like $150 for a December 2025 contract. I mean, December 2026 contract, right? So those are still pretty muted. So I think the market right now is saying to themselves, we can survive the next couple of months of exaggerated prices. And we think that because the Trump administration has already kind of outlined that this is going to be a short-term situation, that it's not going to be a prolonged war, it's not going to be a prolonged shutdown of the Strait of Hormuz, that this is not something that people need to necessarily worry about. And so I think people are watching on the side, because the last thing you want to do is you want to buy a contract 6 months out for $90 a barrel, right? And then what happens is the price of oil drops down to 60, and now you still have to buy at $90, right? And that's the part. Then you're gonna be losing money. So if you do that, so everyone in the sector right now is.
And let's clarify that regular size contracts are 1,000 barrels of oil.
Yeah.
1,000 barrels. You're not it's not like an option contract where it's 100 shares. 1,000 barrels of oil.
Yeah, and what's interesting is one of the things that I've been researching is just how exposed some of these companies and sectors are to futures contracts. So as an example, you have the airlines, right? There are some airlines that they are very proactive in the way that they hedge. So they make sure that they buy their jet fuel at prices way out into the future, because if you're trying to sell a ticket, let's say 9 months out or 6 months out, you want to make sure that your margin is going to be protected. So the only way you do that is by buying oil at a price that you can guarantee that margin, right? So if you sell someone a ticket for $200 and, you know, let's say $50 of that $200 ticket is coming from fuel costs, if the cost of fuel doubles up, now all of a sudden your margin gets completely destroyed because you already made a deal with the customer to fly them for that $200, right? So right now, some companies are smart in that they do hedge a good portion of their needs ahead of time. Others, on the other hand, are not as risk averse, and they're like, fuck it, we'll risk it because there's bigger risk that we pay for this oil ahead of time and then we get stuck with it, and now it shows up as a giant loss on our balance sheet. A company that did that in the past was Southwest. So Southwest had a very strong hedging program in the past, I think prior around COVID. And so what they did is they bought a whole bunch of oil ahead of time. And so those contracts, what happened was those contracts came along and you had to buy this oil, and all of a sudden now demand had actually dropped down significantly. The price of oil dropped down, but you still got to pay the other guy. So if the other guy, you negotiated $80 a barrel of oil, whether your planes are flying or not, you're paying. So that kind of throws you into a really bad place, because on one hand,
for the counterparty, right? Like the guy that's like, yeah, I'll sell to you at 80, sure, whatever.
Yeah, and that's the thing, right? That's why commodity markets are very interesting, and futures markets are always this. But it kind of depends on the organization. So depending on which organization you're looking at, a lot of the estimates on growth this year are based on a steady oil price. So as an example, I'm looking at the cruise lines right now. One of the things I've been doing this weekend while my wife has been out is just looking at what prices that the cruise lines are hedged at. So the market is reacting and saying, holy shit, the cruise lines are going to be negatively impacted by this, this war situation with oil prices. So my question is, well, how much of their production, how much of their utilization is already hedged and hedged at lower prices than it is today? Because if that's the case, then the market is overreacting. And then you have to try to figure out on a futures basis if these guys are smart enough to were smart enough to buy the contracts ahead of time, just in case this thing ends up becoming more prolonged anyway. So like I said, it's all trying to piece together how earnings are going to be impacted, because at the end of the day, you don't want to go into Q3, Q4 and you end up realizing that, hey, wait a second, their profit margin, they were expecting, let's say $2 in earnings, and now their earnings is only $1 because the cost of fuel has surged on them and they weren't smart enough to hedge that. And this way, what happens, the market reacts poorly and then your investments react poorly and all that stuff happens. So right now, this is the time to kind of just sit back, do the research. And so that's what I've been doing this weekend.
I mean, some companies are going to be well hedged, like Chris said. I mean, some companies will have been able to, and this is a positive and negative. Like some companies are well hedged, so meaning like if prices go down, they'll be able to kind of sustain their revenues and be able to continue to reinvest back into their business. But then there's other companies that just play on spot most of the time. They might be selling 1 or 2 months out. And so if you're going to make any sort of rash investments, like, oh my God, I need a full port Devon, or I need a full port, Occidental or something like that, be sure to go into their 10Ks and everything like that to understand how much are they hedged for the future. Because that could mean that actually that revenue might show up or not. And the thing that drives my mind, and I'm actually kind of curious on Chris's thought about this, he mentioned something with respect to oil about some countries playing it riskier in terms of having, their contracts ahead of time, etc. But like India right now is very much at a point where they need to continue to increase their imports of LNG, and their production's falling off, and as well as their future projects are not really there to be able to sustain. Meanwhile, their demand is going up substantially. And so people are sitting here in the chat, like, how do you situate yourselves? Well, that's potentially positive for companies like Venture Global and a Next Decade, where they don't necessarily have all their facilities completely filled with contracts as of yet, versus an LNG Cheniere, meaning they are pretty much all sold out of all their capacity. So unless they build additional trains, then there's no flexibility for them. Versus a Venture Global, they have 8 MTPA on Plaquemines to be able to sell, because technically they're only sold up to the 20 MTPA of the nameplate capacity. And same thing with Calcasieu Pass. Like, they're sold up to 10 MTPA, but they're producing or hoping to produce 2.5 MTPA above that. They could then go to India, who's now in a situation where, oh shit, maybe we need to diversify off of using Iran, because that's most, or not Iran, Qatar, because that's mostly been supplying a lot of their LNG. To say, oh, well, maybe even though it's going to be slightly more expensive, maybe we need to diversify and use U.S. Gulf Coast LNG, or focus on supplying, getting supply from Alaska LNG, which is starting to make a move as well. So it really just takes into account, it's a very volatile space, but I would say if you're going to be investing in it, in specifically for the trading aspect of what's going on right now, it's probably going to continue to be volatile, because as Chris Sutter noted, and Steve noted as well, you're selling contracts, right? And that means you have to take physical delivery. And of that physical delivery, it could go on the opposite direction, right? Like what happened during the pandemic, when people were speculating and nobody actually wanted to take delivery. That's why the prices of those contracts went negative. It's because nobody actually had storage space. Nobody wanted to get involved. And actually take physical delivery. So towards the end, a lot of these speculators needed to find people to take it. So they're actually paying people to get it off their books. Otherwise, they would have had to take physical delivery. Anyway, it just I just caution people to just not jump to any conclusion. Think about this specifically before you make any decisions on trying to play, say, a short-term game here, when you could potentially end up in a situation where you're going long when next week you should be going short, stuff like that.
Yeah. And one thing before that, this goes from the receiver side, but also goes from producer side as well. So I think what happens is people, they look at, oh my God, oil price is $100. Oh, this energy company is going to do crazy well this year. Profit margins are going to double. Yay. And then they're like, wait a second, we sold 99% of our production this year ahead of time. And we can't ramp up production fast enough in order to capture the higher production. So what happens then? So that's the thing. So this is where, like, energy is one of those things that, like, lures retail investors in, but it also screws them a lot too. And one of the things that I think people are getting a little too bullish on too quickly is offshore drilling. Most offshore, let's say right now, the Trump administration came out and says, oh, I think we should do offshore drilling again to get more oil. Okay, great idea. Now, there's 3 challenges with offshore. Number one, break evens for most offshore is like $80, $90. All right, it's expensive. Like, if you're not making at least $80, $90, like, you are not making money. Like, economically, it's very hard. Number 2, you need to get financing in order to actually get that whole thing done. And then you need about, I'd say, at least 3 to 5 years to actually get any output, because you got to, get the rig over there. You got to drill it. You got to do all this stuff. You got to do permitting. So even if, like, let's say you get the approval today, you are not going to be able to get any real production for at least another 5 years. So I think some people are like bidding up offshore, like it's like the best thing ever. Let me buy into every. I think one of them was like Sable Offshore or something. I think that's skyrocketed all of a sudden. I don't even know if they have any production, but it's kind of crazy to see people jumping at this. And I'm like, longer term, right here, look at this. Sable Offshore sourced 74% on renewed optimism. So this is SOC. So just be careful. I've gotten burned by offshore. I bought in at a time where I thought the assets were going to be worth a good amount of money, and I miscalculated on what the cost of the projects would end up being if we got a prolonged downturn in oil prices. And so right now, if you're investing in a project that requires $80, $90 a barrel to be, break even, you're in a pretty bad place, so just be careful.
Have you guys looked at the airlines at all? Because when oil starts to go up, they start to go down. And
once again, it's about hedging, man. Like, which ones are hedged, which ones are not.
But here's the thing. None of them hedge with derivatives anymore. Well, I went through all three of the big ones, Southwest, United, and Delta.
Really?
Southwest historically was an active hedger. They ended the practice in 2025. United also ended hedging. Delta doesn't use derivative hedges either. But what Delta has that is a structural advantage over the two, they own a subsidiary refinery in Pennsylvania with 190,000 barrel per day capacity. Covers nearly 3/4 of their fuel consumption.
So their subsidiary is hedged?
So that it's a structural advantage that Delta has that the other two don't. So while they don't hedge, they do have their own refinery. So it protects Delta from having to pay the refining margin, which is the crack spread between crude oil and refined jet fuel. So I'm looking at Delta and I'm like, you know what? If this stays higher for longer with oil and Delta falls the way the rest of them do, I may make a play on Delta that when they report, their earnings look significantly better than the other two and they catch a bit. I don't have enough data right now, but it's something I'm starting to flush out.
But it'd be by difference, right? Because everyone's still going to be purchasing oil, right? Everyone's still going to be purchasing fuel. It's just Delta might not necessarily have as much of an issue with the refining margin, like you stated. So unless refining margins go up by a substantial margin, which you might be talking about $10, $15 a barrel, like you're not talking about much. I mean, so in that respect, Delta can save a lot on that potential part of the feed cost, but they still have to buy oil at spot.
Correct.
And so they might have a slight advantage, but it's not like you're talking about, basically getting oil for free. They still have to buy it at $100 a barrel.
They'll be able to rebound quicker. So I'm looking for a big decline because, yes, they are all going to be exposed to the current spot price per barrel. But because they have their own refiners, they are going to get some relief because of the crack spread. Now, when oil turns and goes lower, all three will do well, but they'll do inherently better. Every 10% oil increase is roughly roughly $1 billion added to their fuel costs for Delta. So I'm looking at this where, man, the airlines may really fall hard the next couple of months, and then it could be a very interesting time to get in.
Could be, especially if you have like an outsized bet, right? Like an ability. It's like, okay, well, I'll risk, let's say, a unit, whatever your unit is, and it could be a 3-4x unit if prices go back to normal by the end of the year. That is something potentially to think about. And another piece that I didn't really consider, Steve, which when I was talking, it made sense to me, is refining margins might be relatively like $10 to $15, but jet fuel itself is currently at a very more scarce right now than the majority of other distillates. So you're right. I mean, there could
be
all
from refined products.
Yeah. There could be a place where everyone else is at a much bigger headwind because they're paying, an equivalent of $30, $40, $50 more a barrel because of how scarce jet fuel is comparatively versus just like a normal $10, $15 crack spread.
Chris, am I bringing this up?
Yeah, go for it. So this is one of the things I love about AI, that like now you can just search for things and you can see, because it literally goes to all the what is it called, like the filings and stuff. So like Royal Caribbean is hedged 59%, 55%, 45% for 25, 26, 27. So Royal is definitely going to feel it. But right here, they approximately at 487 per metric ton, 476 per metric ton, and 393. So they can handle some blended contracts. Like right now, I think the things jumped up pretty significantly. Norwegian is about 51% this year, and 20% of its total for 27. Carnival is 100% exposed to spot. So if you have someone that's going to take a big hit, if this thing lasts longer than that month, 2 month thing, it's probably going to be Carnival because they're exposed to spot prices. So see, this is how, you want to invest, because like I said, this thing is great, man. It gives you information at the dime. So the company that you don't want to necessarily be long on if oil prices stay higher for longer is Carnival, because it definitely is going to mess up their earnings this year. And then it might actually cut into their leverage reduction targets, and their earnings might actually decline. Carnival Royal is going to be fine. Norwegian's going to be okay. So you see what I mean? 2 seconds. It was a search. Now you know.
It's important. Do that with oil companies, right? Like,
Yeah.
do that with the small companies. The people that are going to benefit the most are the smaller companies, but if they are not hedged, right? But a lot of them do have hedges, so just kind of keep that in mind. Like, don't just be like, oh my god, the small company, it's debt ridden, etc. It's like, well, if it's debt ridden and fully hedged, it's kind of effed, right? So just be cautious.
Typically, the more debt you have on the balance sheet, the more likely it is that you should hedge, because the last thing you want to do is be in a position where your debt financing costs are going to eat away at your profit, and then your profit margin drops, and then all of a sudden now you're in a insolvency standpoint, right? So usually what happens is the more leverage you take on just to be on the safe side, if you're a good CFO, you should be like, hey, we need to be very cautious. Like, we can't handle a discrepancy on price because it could end up screwing us over. So like, let's say right now my debt financing costs are $1 billion a year. My profit is $1 billion. I mean, 2 billion a year, and my net is 1 billion. If my fuel costs double, automatically now it's going to eat away into my profit, and the other part of it is going to go to interest. And if I go into insolvency, then I got bigger problems, because then debt financing costs go up and all sorts of secondary issues go up. So everything's about risk. Right. So the companies and CFOs that can manage risk the best, they're going to do fine. Like right now, Royal Caribbean, they're probably the best position. Their net debt to leverage is like 3 times, and they're still hedged. Carnival is about 3.5 times net debt, and they're not hedged at all. Norwegian is about 5x debt right now, 5.2, 5.4%, depending on where you mark their EBITDA. And they're hedged about 50. So it's sort of a weird situation where each one has kind of got certain caveats, but this just goes to show, from a long-term investing perspective, you want to bet on someone like Royal Caribbean, because they can weather this issue better than everyone else. They don't have as much debt, and they're hedged. Right. So if you were going to say, Chris, which one would outperform in this market if oil stays higher, it's going to be Royal Caribbean.
And a small piece is that you said the CFO might, get the company, but it also might just be the bankers in general. Like the people might be like, look, we're good. If you need this $100 million to drill these several packages of wells, you need to hedge, because we need to make sure that we're going to be able to get this revenue stream coming from this that is actually going to make sense. So it won't just be like, here's $100 million, unhedged, right? It's like, no, to make this deal and an NPV work, you need to have and sell your oil between $60 and $70 a barrel. So we're going to make you hedge that, or at least 80% of it, so we can guarantee that we're getting our $100 million back over the course of, say, 5-10 years. So it might not necessarily be a CFO, but although a smart CFO should be thinking in that manner to make sure. And it's okay. What they could do then is say, on a downside case where it does dip to $40, $50 and they're hedged at 80%, they'll still be able to have, like, let's say, a decent NPV or IRR associated with that project. But most oil companies will say, hey, we're guaranteeing that, we have a break-even price of XYZ. We have the financial wherewithal to survive any sort of downturns, but we don't want to cap our upside. So they don't hedge in certain cases. So, but I'm also starting to think, like, if this persists, right? Say this persists for several quarters. I don't think it will persist based off of the current strip pricing, but I guess we'll see as we go into next week. But if this does persist and those outer months actually start to creep up into the mid 70s, $80 a barrel range, this could actually be very beneficial for solar having a comeback. And people starting to shift, like, oh, we need to decouple ourselves from cheap natural gas and cheap oil again. And I'm not saying it's actually going to play through, but it could be a trade that, if this actually does keep up. I remember 2008 when oil prices were skyrocketing to $150 a barrel. right? Obama was very much like, nope, we need to get in, Solera, not Solero, whatever, all those companies that he was trying to subsidize to be able to get off the ground to get us off of oil when oil was over $100 a barrel. I wouldn't be surprised if people start chirping up about that again. And so that there could be a trade there for some of these solar companies that have seen some of a hit in recent quarters to potentially take a quick trade on that if this persists. It might have already happened. I don't know.
It's funny, Matt. While you were saying that, I just looked up who has the least unhedged barrels. EOG, and that's in your portfolio. So they're going to benefit from this. So if they do I have to look at their collars, like what kind of, if they have any, but yeah, EOG. What did EOG do last couple of days?
Good question.
It was actually flat. Surprisingly.
Enphase is up for different reasons though. Enphase is up because they're doing something that I wanted them to do like 3 years ago when I was always arguing with Vitali and Carlos about it. And they're actually getting into commercial instead of just hyper focusing on retail. And my thought process has always been there's going to be a subset of people that, yes, they want solar panels for their retail homes, etc. But the majority of the world is going to benefit from solar transition as an entire commercial industry, right? You don't have an oil well in your house, right? Like you outsource that to the oil companies. And I know oil is different because it obviously requires, you can't just drill anywhere and get oil out of the ground. But same thing with having water wells. Not everywhere has water wells. Yes, there's some of you on this call that have water wells, but the majority of the time you outsource that because you don't want to maintain the water wells in your home. You don't want to continue to worry about drilling. Maybe you drill it and you find a water well. So to me, solar panels are great, but that means you have to make sure that it's working, right? And that it's not dusted over and all that. So reality, it's about commercial solar going forward, not necessarily the retail.
Interesting.
Sorry, what else were you seeing? Yeah.
No, I just got curious. I didn't realize EOG. Look at this. They have a good amount of production their EPS should be skyrocketing in the next couple of years, especially if the longer dated contracts that they can sell some of those. Dude, their net profit is going to go. This thing's only trading at like 15 times. Interesting.
NRI, what the hell? The basins that they're in that NRI, Jesus, 31%.
Yeah, look at this.
Override? That's crazy.
They've got a lot of acreage, man. That's for sure.
Hold on, what is this? This is Utica?
Because they combine this. So this is Utica, yeah.
Chino. Oh yeah, I saw that. I think was it Granite Ridge got involved with this? Maybe it was Northern. I forget. Night Dookie Pie, thank you for stopping by.
Night Dookie.
Yeah, but look at this. This is EOG for the last 5 years. They've been okay. So you're not even buying at an expensive price right now. If oil persists longer, dude, this thing could go up pretty significantly in a very short period of time. It's already gone up since December from 101 to 130.
But look at EOG on a 5 year. It's relatively sideways.
Yeah, but that's what I'm saying, that the market right now, they can maintain pricing right now at 70. What was it been, like $60 a barrel? They've been able to maintain profitability at a 15 PE, which means not even 15, probably like a 10. So that means that their profit margin, if this thing stays above 80 for a prolonged period of time, you're looking at literally all of that shit falls right to the bottom line, man. Every single dollar additional is going to go to the bottom line, which means that this thing could theoretically rise to probably like, I don't know, I have to do the math on it, but maybe this is one of those things that we do on the side. Matt, me and you sit down and just
maybe take a look. EOG also has some access to Trinidad, and I don't know what spot prices would look like at Trinidad, but they also have, that's part of the reason why I was living in Trinidad, right? Was they have LNG facilities there. EOG, I don't believe, has any ownership in Atlantic LNG, which is the LNG facility in Trinidad, but they sell to Atlantic LNG, and so if spot prices go up, that obviously could have an impact on EOG's bottom line in Trinidad as well.
You know, what's surprising? Their options haven't gone up much either. I'm actually a bit
whenever
shocked.
Chris is looking down like that, you know he's on the option calculator because it's on his phone.
No, the thing is, I'm looking at this and I'm like trying to understand like why EOG's options volume hasn't spiked on this news, because usually what happens is things like this happen and you get a pretty big spike in let me see, EOG, especially for longer dated contracts. Let me see.
Sorry, I made a statement that I think Northern Oil and Gas. Maybe I didn't. Maybe I thought in my head. Northern Oil and Gas took
about Northern yet.
Okay,
I have to.
Don't worry about it then.
Yeah,
I thought the Utica. There was a deal done in the Utica. And Northern Oil and Gas was a part of it, but I wasn't sure if it was EOG or if it was them. So sorry.
I'll take a look later. But I think when we get a chance, Matt, maybe after this, we could take a look together and just have a nice sidebar to figure out, like, okay, if they were to start selling some of their futures contracts, what kind of profitability would they be looking at? And I wonder if they have any. I haven't done any research. I don't know if you have, but if they have any share buyback programs active, because they do have a 3% yield. EOG. Do you know if they have a buyback program? Let me see.
I feel like they would have to. Most. I mean, EOG is really one. That's why I bought them. They're one of the more well-run independents, and they're larger than most. They're almost as large as some of the super majors at this point. I think the reason why they're not is they're more so focused on Western Hemisphere. They don't really have as much of a.
Can you share my screen?
They are starting to get a little Middle Eastern presence as well, but maybe I should stop talking.
Yeah, let's see. Okay, so that's that. Let's look at their cash flows. See this operating cash.
Fun fact: EOG stands for Enron Oil and Gas.
Oh, you should have left that out.
Why is that?
Because the name Enron. Okay, so this is their cash flows, which were down year over year, but I'm sure that this is gonna definitely go up after their one acquisition, their acreage plus this, and their repurchases, net repurchases have been doing about $2 billion right now. Yeah, this goes up, and earnings, EPS is diluted count, diluted in EBITDA. Yeah, see this? This is why it's been sort of down, because their diluted EPS has been on the decline, which I'm sure is going to reverse. Maybe this is what the market is not necessarily like recognizing right now. Because you see this drop off. This is the problem with investing in cyclical businesses. Whenever oil prices are higher, they typically make a lot of money. So if you guys remember from December of 20, things were negative. And then you had the Russia-Ukraine war situation happen, and their diluted EPS skyrocketed. And then what happened? Then the price of oil came down, and those contracts that they probably had, the contracts that they sold out forwards started to go down. And so their EPS started to decline. And now you're probably going to see a nice upward move this way. And if they're generating excess cash flow, they could probably return it to shareholders, or maybe even paying down some debt. So let's see.
But this just goes to show the beauty of, I mean, if you were to overlay the price of oil and the net margin that EOG has been able to achieve and keep their EPS as flat, and maybe that is partly due to large buybacks, but the price of oil from 2022 to 2024, when I started to be very bearish on oil and gas companies, and I was predicting, everyone was fighting me in 24 about how oil was going back to 100, and I said, nope, it's going lower. They were able to maintain pretty decent EPS. Yes, it did shrink, but it didn't go from like, it didn't get cut in half like everyone was kind of expecting it to.
Yeah.
For EOG earnings, I mean.
So here's what happened. they were able to buy up acreage for cheap. And now, if you look at it, where's their net debt? That net debt to EBITDA. Net debt to EBITDA. Okay, there we go. So their net debt to EBITDA it's like nothing. They're not even levered that much, but they could literally take out this debt and return shit ton of value to shareholders if this thing goes longer than before. And they were reliably generating. See, this is the one thing I wish you could do with fiscal AI. I'm going to ask that they kind of build this in there, but you can add something. You can add like commodity prices into this thing. I wonder if they actually have that. This is the net acres. So look at their net acres, probably jumped up. Net acres total. Let me get rid of these things.
So, Chris, save some of your brain power because the next topic, we got Oracle and Adobe reporting this week.
Yeah, you see all this additional acres. They almost took on, look at this, Matt, 1.2 million net acres they took on additional.
That was from the Utica deal, right?
Yeah. So it's crazy because they probably got a sweetheart of a deal right before the damn prices skyrocketed. And the market hasn't picked this up yet. Huh. Interesting.
I think it's smart. The Utica, I think a lot of people got out of the Utica when gas prices collapsed in the mid to late, the mid 2010s. So gas prices came into the decade very good, coming off the back of 2008 when gas prices went north of $10 an MCF. So everything looked really good, and everybody rushed to buy stuff in like Haynesville, etc. And anybody that had a really good portfolio in gas did really well in the late 2000s. And then as 2010, 2011 came in and fracking started happening, and oil or gas being a byproduct of oil, and everybody getting after oil production, there was just so much gas. And that's when things got actually pushed to below $2 an MCF. And that's what we've been kind of crawling ourselves back from ever since.
Yeah,
now I think the feedstock is going to be so good because we're going to be exporting so much that you have an opportunity to be investing now in the Marcellus, investing in Utica, investing in Haynesville, because the floor price I feel like is really good.
Look at their natural gas and their natural gas liquids revenue. It's been good. Let's see, natural gas. Let me get rid of the acres. Okay. So this is their natural gas liquids revenue, which is about 2.3 billion a year, and then their natural gas revenue. Get rid of this thing. Is this so? And then let me just put on there, and then crude is right here.
Train Claude on Chris Patel videos and just be like, Claude, make me a Chris Patel agent to investigate this company.
Huh. Look at this. About, what is this? Like 35% of their rev comes from natural gas. And this was at last year, which was like $3. What is it? What's natural gas at right now?
320.
Okay. Well,
what was the question? What was the statement, Chris?
No, I was saying most of their rev is actually coming from crude. It's not. I thought more of it might be coming from their natural gas, but it's not necessarily the case. Most of it's coming from their crude, and then like their new acquisition that they just made in the Utica. I wonder like what percentage of the output is gas versus
oil.
Gas or oil. Yeah,
even NGLs are extremely profitable. Like I mean, you're not getting the price of oil, but sometimes it could be 30 to 40, sometimes 50% of a barrel of oil.
So, do you guys know which midstream operator has the best NGL business?
Midstream operator?
Probably KMI, right?
Enterprise Product Partners. So they have the largest NGL business. And from their practitioners, if I said that correctly, the way that they contract for specific minerals. All the byproducts they're not contracted for, they get to keep. It's very interesting.
That is really interesting. And to educate the group here, I'm not trying to, mansplain here, but the difference between LNG and NGLs is very different. LNG is like 100, should be about 100% methane, and the goal of that is to liquefy it and reduce the temperature of it so that it actually, the methane goes into a liquid. Versus NGLs, you're talking things that have higher carbon components. So you're talking about the propanes and potentially even butanes of the world, that at certain temperatures and pressures, they actually turn into liquid. So if you actually pick up a propane tank, right, you'll, if you swirl it around, you'll actually feel liquid in there. We're talking about that sort of stuff, right? So at a certain pressure, it's going to be and they're used for different things, right? You're using propane for different things versus butane, etc. So that's what we mean by NGLs. It's obviously more valuable than, say, natural gas, and it has a different component. It's more transportable, which is partly the reason why you get a premium for it as well. So yeah, just kind of keep that in mind when you're talking and hearing people talk. And then there's a difference as well when people talk about LPG, right? Petroleum gas as well. So
yeah, that's interesting.
Yes, thank you for the membership. I saw somebody became a member on my channel. Much appreciated. What was it? Let me give it. Cheeky. Thank you, Cheeky.
Their crude production was going down, but I assume that their crude is probably going to go up. But look at their revenue from natural gas. Pretty much tracks the whole like data center build out, right? Data centers get built out. All of a sudden now you need more natural gas. Natural gas prices go higher, and then you have all this export capacity. So I wonder what percentage of Utica is gas. It's probably gassier, right?
Utica is gassier, but there's an actual oil window, and there's a pretty good NGL window. Huh. And so people understand, right? So as you would expect in a reservoir, specifically large ones like the Permian, etc., think about oil like soda. So if you have like a can of soda, which I don't have one in front of me, but you'll have a piece where you have strictly the top, which is a gas cap, which is like there's no oil in there, and then you'll have a piece where there's the actual liquid itself, and within the liquid is gas, right? So it's like soda, it's like CO2 embedded in the liquids, but as you reduce pressure, that gas comes out of solution. That's why you have flat soda, like, oh, this tastes like garbage because the soda's flat. So it's the same sort of thing with oil reservoirs themselves. Depending on where you are in the reservoir in terms of pressure, you'll potentially have like an actual gas window. But just like in the scenario of the soda, right? You'll have an area where that transition actually occurs. And depending on when that transition occurs, you could have gassier liquids. So the heavier components, as always, are going to go to the bottom. So you might have, I don't want to say heavy oils, but you'll have actual oils, right? The things that have dropped out because they can't go into solution just based off the composition of the reservoir fluid. But then you'll have the actual pure gas. So depending on where you're at and what type of composition your reservoir fluids have, you could have more or less NGLs. And the piece that's also something to consider as well, depending on where you are in the world, you might have to strip your gas more or less depending on the temperature at which it's going to be transported. So if you're like in Alaska or Canada, you're gonna have to strip more, and so it actually might be more expensive to strip your gases, etc. Because you think about it, those temperatures get down to negative degrees, and so you have to remove all the water, you have to remove all the liquid content, otherwise it might freeze. Versus if you're in, say, the Gulf Coast area, you don't necessarily have to reduce the amount of liquids that are actually in it as much. So there's a cost benefit analysis of it as well, because obviously the value that you get from your NGLs is much higher than, say, your natural gas prices, meaning methane gas prices. So yeah, piece of facilities engineering there for you.
What's funny is Tommy, I guess, in the chat is like, EOG has weak cash flow. Did have weak cash flow is the right answer here. Like I said, it's all about longer term oil prices, right? If oil prices can go up significantly, then you're fine. Everything will be good. But what do you think, Matt? Do you think longer term oil stays above $70-$80 a barrel? You think it should be around there?
It depends if there's ongoing geopolitical conflicts. I think the world is still very oversupplied with gas. Guyana coming in, and I don't think this will help. Right. So if this, say for example, this persists for, let's say, 4 or 5 months, you're going to see a lot of people start to say, "Oh shit! Well, we should probably get ourselves an insurance policy and developing more onshore oil." So my thought process is that we were never really going to exceed 14, 15 million barrels a day here in the United States. Well, if you start to sustain above $80 a barrel, you're going to get a lot of additional mom and pops that are like, let's go drilling, right? Like and then the thing that's nice now comparatively to where you were maybe in the late 2000s, early 20 teens, is a lot of these oil and gas companies are in the best financial shape that they've been in for a very long time. As you just alluded to with EOG, very little leverage. And most oil companies, super majors specifically, except a select few, are actually in the same position. And so they might have the ability to do what Exxon did throughout the late 2010s, which is really go into their coffers and be like, let's go into debt to get this next. It's very much what's going on with a lot of these technology companies right now, which is like, hey, we don't mind going into debt to be able to get these new cash streams online. So if that's the case and people start leaning towards that way, then you could actually end up in a worse situation, because if the geopolitical tensions fall out again in terms of like just going to be not an issue, then now you have more oil production that people were starting to think like, oh shit, like we weren't expecting this. And then it's going to even collapse the oil price even more so. Maybe it's not even leveling off at $60 a barrel anymore. Maybe it's creeping into the mid to low 50s, if not the high 40s. So yeah, there's some potential depending on what happens. There's so many different outcomes. I don't know. I mean, I personally, I'm an optimist, I guess. So my thought process is that I hope the ongoing skirmish in the Middle East kind of ceases. It seems like Iran already kind of took a step back and say, we shouldn't attack the other countries. We apologize, etc. So to me, that means that they're at least trying to get to a place where there's a potential negotiation, to which I think the U.S. has a lot of leverage on that. But if that's the case, then I think that oil goes back to maybe the 65, 70. There might be a hangover where oil prices stay elevated in case people think that there's going to be an ongoing skirmish or a reignition of skirmish. Kind of like how it took a long time for everything after the Russia-Ukraine, when that supply chain got disrupted. It took a long time for that to sell off. And that's when I started to see the writing on the wall, and I sold my Exxon way too early. But it's okay. I put it in other things that made a lot of money and did really well. But I don't know. I mean, it's tough. These ongoing skirmishes, it's all about supply chain, right?
I wonder. Usually energy tends to do well under Democrats. I know it's counterintuitive, right? You're thinking, oh, Republicans are like the energy guys, right? And I'm like, no. Usually Republicans are very drill, baby, drill, which means commodity prices go down. But if you're an incumbent and you're producing, the last thing you want is more supply coming on. So let's say next election cycle, a bunch of Democrats win, bro. Venture Global is going to do extremely well under the Democrats. Why? Because they already have the construction, the permitting, everything.
No more LNG ongoing plants and this and that. And next thing you know, you're like, oh shit, they're the only game in town. Yeah. So it's 100% exactly right. It's so fun because you get after it. Activity is plentiful in a more Republican sort of leaning administration. But you're 100% right? Like people were starting to get, like, our jobs were, I mean, I mostly focus Gulf of America. I don't anymore. I'm more global facing, but in the past when it was very much Gulf of America focused, fucking working under Biden sucked. Like we didn't have lease sales for a long time. And if you don't have lease sales, look, no offense, I'm not trying to make this political, but look what happened to the United Kingdom North Sea. Like if you don't regulate it appropriately, you completely kill your industry. And that's what's currently going on in the UK North Sea, is with all the different regulations that have been enacted, coupled with the windfall taxes, etc. So anyway, like you stated, it's definitely most of the time cheaper under Republicans, but you get after a lot more activity, and that's probably why. But yeah, the Democrats could very much be beneficial if you are already sanctioned and if you're going through, because it helps with the scarcity.
Imagine 8 years, no new projects, only additional bolt-ons. Probably Venture Global will end up dominating for the next. I mean, look at, like I said, let's say Congress gets flipped, right? That's like the first hit that you would end up having, and then you'd have a president. Remember what Biden was doing? You put a moratorium on new construction, like the moratorium. So, you get an EPA that could end up doing that. In which case now you've got no new production for 8 years, no construction for 8 years. Dude, you can build up a solid business. If the Democrat, man, I might vote Democrat just to make sure my portfolio returns go up. Because I have a pretty decent position.
And so then if you think about it like that's why we discuss, guys, I just want you to hear this. This is why we discuss politics slightly on the channel, is because it does have implications on the future of some of these companies. A prime example, I'll bring up a Venture Global, as Chris was kind of alluding to here. That's why they canceled the Delta project. Not because they don't think it's economic. I guarantee the Delta project could be very economic. But by the time they actually get around to it, think about it. We're just starting construction on the CP2 project. Then there's a CP3 project. And then you go to Delta for Venture Global. So what's better? Well, you already have the Calcasieu project and you have excess space, and you already have the Plaquemines project and the excess space bolt on, and spend that capital where you can guarantee you'll get it through, versus let's just say a Delta project. By the time Trump says, yeah, sure, go ahead. But by the time you actually get approval to start actually cutting steel and ordering turbines and everything like that, and actually getting it FID'd, who knows who's going to be in office? So it's very difficult. You want to get things sanctioned and going forward first to make sure you secure that capacity to benefit the project. So anyway, that's some pieces.
Are we voting Democrat next election cycle to make sure our natural gas?
I don't think I'm rich enough yet, Chris. I don't think I'm rich enough. If I was that rich, and I'd be like, "This is $1 billion. I'm voting." I'll start lobbying and shit. When I start lobbying Democrat, that
you're rich, right?
Yeah.
See, this is the funny thing. Like, so, okay, I grew up in New York, right? And New York, heavily Democrat area. So it kind of like goes counter to what their narrative is. The narrative is Democrats are, the ones that are high tax and everything else, right? So bad for business, high tax. Like that's the general consensus. The thing is, though, if you are an incumbent, the Democrats are the bomb for you, man. If you want to be in real estate, bro, the last thing you want is people building more housing. Who's really good at not building houses? Democrats. All right. If you go to New York City, AOC torpedoed Amazon coming into the area. Okay, torpedoed. Why? Because Amazon would have came in, they would have said, here's more money for the coffers, let's build more housing, let's do this. Nope. Torpedo. Now Long Island City, they're not really developing it much, and it's just going to sit there. Now, you would think like, oh, wait a second, that means no additional housing. But here's the thing. That means that now there's no competition for all the Manhattan landlords that are sitting on a bunch of commercial real estate that they would have had to compete against in Long Island City had Long Island City been actually developed a lot more, right? So at the end of the day, if you're a wealthy landowner or a landlord, who's better for you? Is it going to be the Republicans who want to build more homes, or is it going to be the Democrats who are like, no, we can't build any more homes, we can't do this, we can't do that? I mean, people right now, I look at this whole thing with Mamdani, right? And he's talking about like freezing rents, right? That's his thing that he's running on. Like, I'm going to freeze rents. I'm going to make sure that landlords can't raise rents. He can't really do that on the market side. But when you say people can't raise rents, do you know what that does? That stops people from building new homes because you can't do it economically. So the people that already have the homes that are landlords, what can they do? They can keep raising the rents. That's why the rent prices, if you look at it in like Democrat-run areas, are literally probably like 2 or 3 times more expensive than areas that Republicans run. So on one hand, the Democrats are the party of affordability, but every policy that they come up with does the exact opposite. And the Republicans are usually the ones that are like, oh no, you know what? We need to be fiscally responsible and fiscally conservative. But at the same time, their policy actually lower the cost of it. It's such a weird dynamic, man. It's like whatever the party does, their policy ends up doing the opposite. It's a kick-out show. What?
Somebody in the chat asked what the White House card is for the UFC.
Yeah.
Apparently somebody pulled out already, right?
Yeah, they had to redo it. There was a big pullout last night.
Maybe I should get my sources. Maybe I can get us some ringside.
Whatever. I don't know. Like this is one of the things I love about politics. When I look at it, I used to think that, oh, a Republican coming in charge, buy energy stocks because that's good. And then I realized in practice, it's actually the opposite.
Mm-hmm. Oh, yeah. I mean,
well, we got 2 big earnings next week, Adobe and Oracle. Where do we think this goes?
Adobe will do fine. Oracle's a question mark, only because Oracle will have to sort of answer questions on why they're this is going to be bad. I think some people in the chat are not going to like what I'm about to say, but I'm going to say it. I think, yes, there's still a ton of demand for AI, but I think we're slowly graduating from hey, I think AI is amazing. I think everyone should use AI to, hey, is AI actually generating value? And if you're not generating value, then it's not going to be nearly as free anymore. So if you guys remember anything, it's like the crack dealer, right? What do the crack dealers do? They get you on the crack by giving you free crack. So all these people now, everyone is AI. What do you think everyone is going to do now? They're going to raise prices. They're going to make sure they're profitable. Shit, I had to upgrade Claude. I love Claude. I can't live without Claude anymore.
Dude, I'm on the $200 a month plan.
Me too. I love Claude. Like, Claude is the bomb.com, so now before I was like running free shit on ChatGPT, and then I paid a little bit to Gemini. Now I'm Claude,
Claude is so much better. It is light years better than everything else.
Yes, agree.
Light years.
Agree.
So Oracle scares the shit out of me, and here's why. So I ran some numbers. They have a worse EBITDA to debt ratio than Verizon. And I think it's only going to get worse. I mean, and Verizon's not even that bad. People look at Verizon, 141 billion in long-term debt. Oh my God, but they do 50 billion in EBITDA. It's not a big deal. Now, Oracle, I'm expecting long-term debt to go up this quarter. I don't know how much EBITDA is going to go up, but they're trading at almost 4 times. That is scary. And the amount of stuff that they're doing, I can completely see their long-term debt going to 125 this quarter. So I'm a little worried. Now, I also think there's 2 ways to look at Oracle. The balance sheet sucks. We all know it. They have negative 80 billion liquidity. That can get worse in the short term. But if you look at the income statement and the earnings per share, it's very interesting, especially if they ramp revenue the way that they believe they're going to ramp revenue. So if Oracle goes down to 125, 120, I think I'm starting a long-term position. If we get, selfishly, I'm looking for it to drop this week so I can establish a position.
An Oracle? I'm going to wait a little bit only because I need to see their EBITDA start to rise. That actually makes sense. I do like the fact, like Roy said that was bearish, but I was like, I thought it was actually bullish for an investor standpoint, because now you know that they're going into cost rationalization, and so that reduces down future uncertainty. That should be bullish for the company. No?
I would think so. I mean, I'm just looking at the projections. I'm looking at how they're spending, and I'm looking at where over the past 2-3 years, when their peers spent and how much their cash from operations and EBITDA grew. If we apply the same methodology to Oracle, this could be a really interesting play, not for this year, but look, I know that I can't catch the bottom. I know that whenever I buy, it's likely not going to be the bottom. But if I buy multiple times and scale into it, I do think Oracle is going to be significantly higher 2 or 3 years from now than it is today.
Yeah, I mean, they also have this whole thing with TikTok. You guys remember? Like everyone kind of forgot about that, but all of that stuff is getting dumped onto Oracle. So, Fed sued over TikTok sale to companies led by Oracle. So Oracle's future RPO is probably going to jump up. And then you've got this acquisition of Warner Brothers Discovery, which means all the microservices should jump up for Oracle. So everything is going to transition from Paramount to and what is it called? And Warner Brothers. Everything is going to go back to Oracle again. And I think that's what Ellison is trying to do, in that he's trying to replicate Google. I know if that sounds a little weird, but what do you guys think about that theory? So if you look at all the things that Google has, right, with the exception of search, you've got a cloud business, you've got YouTube, you've got all this autonomous and all this other stuff. So now with TikTok, you've got this presence from social media / content creation, very similar to YouTube for that. So you've got ads monetization that could come from there, and then you've got Warner Brothers Discovery and Paramount acting like a YouTube proxy. I don't know. I wonder how this.
He hasn't bought in all of Hawaii yet, so in this respect, like, he's got to generate those profits.
Yeah,
no, I don't know. I think it's very. I hear what you're saying. I was thinking about that the other day. It's like, man, they're really, between Elon buying X and several other folks really trying to buy some of these legacy companies that are heavy in media. It's very interesting. Curious what the long-term implications of this will be from a pendulum swing of potential how the democracy progresses forward into the 2030s and beyond.
You want to know something crazy? You know what one of the best performing stocks last year was? When I show you guys, you'll be shocked. Let's take a look. New York Times.
Shocked.
New York Times is up 63% last year.
What about the last 5 years?
Let's see.
I'm not trying to be like, oh
yeah, no.
Oh wow. Okay.
From 29 to 80. You know who bought a bunch of New York Times?
Uncle Warren.
Warren Buffett. That's right.
You want to know how I know that?
How?
www.probably.xyz.
Let's check it out. Well, here, just throw it in there. www.probably
with an I, not a Y.
.com. Okay.
No, XYZ.
Okay.
Let's do probably.xyz.
Okay.
Maybe it went down. Maybe it crashed.
Probably XYZ. Let's see if it ranks
with
on
a
Google.
I, not a Y.
Okay. Hold on, man. I'm sorry you're dyslexic and can't spell, but I actually know how to spell. There we go.
Go to Explorer 13Fs.
Did you put an ad on here, or was that just a radio?
Don't worry about that.
You got ads on here already, you greedy
I'm trying to figure out how to make it free for people. I don't want to charge people, so I'm trying to make it a way to free. Okay.
You got me.
Hold on. Was the ad working though?
I saw the button for it. I didn't see any
Okay.
ads. Hold on, I'll
Google,
reload.
I don't think Google's approved it yet, but we'll see.
Bro, you're not even 3 days into this. You're like, monetize this. Let's go.
I want to make it free for people. I don't want to charge people, so I'm trying to make it.
If you gotta watch a condom ad, you gotta watch a condom ad. That's fine.
Hey man, I'm already like $750 into making this damn thing. Go to Explore.
Okay.
In the upper right.
Got it. Okay. And 13 Fs. I am not gonna lie, this is very clean, dude. I was talking to you about it earlier, and let's see.
Zoom in a little bit because it check out that. Don't play the play button on the right side, but yeah, you guys can listen to music. Which I wanted it to be royalty free, but
let's see. Searching for New York Times across. Matt, you got to put this behind a paywall, bro. Someone's gonna DDoS attack this thing, man, and then their compute is just gonna go insane. Let's see. New York
Taking
Times,
a minute.
16 funds hold it, bro. It's literally looking through 6,200 funds. I don't mind waiting a little bit. Let's see. 17 funds unloaded. 16 funds. Oh, so you actually have like a timeline. It's taking a minute.
But do Berkshire or even the heat map or something. I need to work on this because there's a lot in here and I want to streamline it a little bit. But
Berkshire, no,
doesn't bring it up.
No,
see, not a good representation. Maybe under the heat map or funds. Maybe if you type in funds instead of just the overview.
No, but I'm just it's indexing all this stuff, man. It's like indexing 72.
No. That's just because it's running through all. So go scroll up.
Okay.
Go to the funds piece.
Okay, got it.
And then type in Berkshire.
Ah, right here.
Or search for it.
New York Times. Okay, right here. Loading. No.
Well, that's the holdings. That's you're looking for 13F. You need to look for Berkshire.
Okay, Berkshire Hathaway right here. Okay. Oh, cool. So now I have this. And Liberty Media, Moody's, New York Times. There it is. New York Times. So Uncle Warren bought it. 5 million shares.
But yeah, I need to. There's a lot of information in this 13F thing, but I need to make it more navigatable.
Yeah,
you can get lost in here, but it needs.
No, it's pretty good, man. It's pretty good. I like it, and you can see a timeline on things like New York Times. Oh, these are all the
how
ratings?
late people report. How late people are reporting to see if they're like trying to hide things.
Ah, okay. Does
it have
map,
like I think is my favorite. Go to heat map.
Okay. Heat map. Okay.
It shows like all the largest stocks. You can see who's adding, who's closing, what percentages is of their portfolio. So the coolest thing is look at Berkshire. They have a lot of holes. Like they don't own a lot, but and then if you go to Renaissance Technology, Rentech owns a shit ton of companies. They own like every company, but then they only own like 0.1% of their portfolio in any single.
But the thing is, they're always actively buying and selling based on their algorithmic models. They're not long-term holders, you know?
Yeah.
Like Rentech is always looking for, they use their, what are they called? They use their models to basically identify companies. And these are things that it's not technicals like, oh, RSI is down to 30, so buy. Like, no, they use like, what's the term for it? I don't know. I forgot they're a quant firm, but they use these patterns. It's almost like this pattern recognition thing. So what they do is they take data points from pretty much everywhere. They combine them all together, and then they use that data to identify like which areas that they should invest in, right? So as an example, like let's say ship activity, like let's say like warship activity moving out of Virginia and closer to the Middle East. And so people were like, oh, that means that, you know, the US is going to attack Iran, buy oil futures. you could have made money that way. It wasn't based on any technical indicators, but it was based on this other thing. So I forgot what the actual name of it was, but it was a very interesting thing. Let me see. Hold on. Renaissance technologies patterns. What was it? Seasonality. They have a whole bunch of stuff, man. Their algorithm is just on another level.
Thanks to everyone using the site, by the way. We're up to like 450 daily active users at the moment.
Yeah, it's on the tip of my tongue, but I can't. Whatever.
Steve, why are you being so quiet?
I'm just letting you guys talk.
What have you thought about the last 8 things that you just let us talk about?
I mean, a lot of thoughts, Matt. A lot of thoughts. I'm actually thinking about Netflix, to be honest with you.
Still, well, run us through that, because somebody asked me that the other day and I couldn't give a good answer.
The company that they acquired from Ben Affleck is an AI company that's going to help them cut production costs. It's going to do a lot of AI enhancements. And I think that we're going to be in the age where in the next several years, they're going to have an upgraded tiered platform where you can build out content. I think it's going to happen quicker than what people think. It may not be to the point where you're completely replacing things, but I think the Hollywood model is going to evolve, and actors and actresses will lease their likeness to these platforms, and every time you prompt something, they get paid. Or for X amount of money, you can lease their likeness and build something in the Netflix environment. And I think it'll be just an additional way for them to generate revenue, not just for the platform, but another way for actors and actresses. And it'll allow us to, so for instance, I just started watching The Waterfront on Netflix. Show is incredible. One season and it's done because the production costs were too much. So I think
advertise more. Like
I'll be able to get a second season out of it. And these actors will be able to generate money because even though they didn't create a second season, you'll be able to pay a fee and use their likeness to develop a second season or a couple more episodes. I think that's where this is headed.
I think I realize why Steve is so quiet now.
Why?
What's on the other monitor, Steve?
I only have one monitor.
Oh.
It may be 49 inches, but I only have one monitor.
Well, it's about 46 more than I got. So
it was hidden Markov figures. That's what Renaissance Technologies uses. They use so many fucking crazy things, man. That guy, Jim Simmons, a smart dude, man. He was actually the professor over at Stony Brook in their math department. I never got to I should have actually taken some time and spoke to the guy. All right, boys. I think I'm done.
On it.
Yeah.
What are you
Unless
buying
you
this
guys
week,
have
Chris?
something. Nothing, dude. Nothing actually. I am looking at maybe buying some cruise lines. We'll see.
Why would you buy cruise lines going into a silly question? Why would you buy cruise lines going into a price rising environment for oil and feedstock?
Because I'm reading the situation and it seems like the administration's goal this year is to keep things stable. They don't want to raise inflation. And so I think that they're more on a time limit than people think. And I think the rate at which they're making all the moves, I think at some point this all ends, maybe at the end of this month. And if it ends at the end of this month and traffic is restored to the Strait of Hormuz, then automatically I think the market's going to react positively. And the companies that have been sold off in the last few couple of weeks because of this whole thing are probably going to take a nice little V-shaped recovery. So, I think that there's actually maybe a short-term opportunity. I'm not saying that I'm going to go absolutely crazy and buy into this shit, but typically when you have a president who does benchmark his progress based on some of the promises that he's made, and I think that some of the indicators for me that he does want to keep oil prices in check is a couple of things. Number one, they unsanctioned Russian oil, which is a crazy thing to do. And then they guaranteed shipping like through the Strait of Hormuz with the U.S. Commerce Department guaranteeing the insurance. You've got a third carrier on the way to kind of make sure that there's more protection for the thing. I think at some point Iran's going to run out of ammunition because they're pretty much stuck. So I think everything points towards this not being necessarily a prolonged war situation. And if that's the case and we start to see some resolutions come up, then it just means that the companies that got sold off because of this news could end up recovering from it. So, it's almost like a calculated risk that I'm taking. If I go that route, I haven't decided whether I want to. I'm still waiting on some key developments. But yeah, I think if there's any sort of resolution to this, we could see a rally in some of the sectors that have been hit by this. Does that make sense? Kind of.
Mm-hmm.
Yeah.
Charles, thank you.
To the end of this week.
This week, and it's going to be done?
Not this week. So thank you, Charles, very much. Very
much appreciated, Charles. Love you. Everybody follow Charles on X and on YouTube. She has great vlogs.
Looking forward to Chicago, and you still have a mission, Charles. Best Chicago pizza. I'm coming for it.
You know what I want, Steve, out of that Chicago trip? I want to go to like 8 different places where we just split pies and like Italian beefs.
Are you coming to Chicago?
As long as I don't shit. Now I'm thinking I got a business trip now.
What do you mean?
When is it?
You're missing California.
No. I didn't have any forecasted business trips. Now I have a few. So what?
I think it's the 28th of May, I think. It's the last weekend of May.
All right. If it's the last weekend, I think I'll be good. Fingers crossed.
Okay, P-Quads. P-Quads is the best.
Chris, are you going to Chicago?
I don't know yet.
You going to Cali?
I am going to California. I will see you there.
Right.
If it's like the 30th, 31st, I definitely think I should be okay. I think the middle of the month I might be.
I may have a rule that I'm not going to talk about stocks while I'm there though, because last time, bro, everyone started asking me questions and I was just, I almost got left behind at the what is it called, at the place, because everyone just, the thing is, like, I didn't want to be a dick and be like, listen guys, I don't want to talk right now. I just want to go and hang out with the guys and get some dinner.
On which one are you talking about? I'm trying.
No, New York. Everyone was asking a lot of questions and stuff like that. So what do you think about this? What do you think about that? When we went to the thing went to the meetup.
Well, I mean, that's why they're there, to hear and get your thoughts. But I think I'm curious to see how these things change, because I think there could be an opportunity, because a lot of what I was asked was like, what do you think of Venture Global? It's just like, I could easily, if we just did like a 30-minute fireside with everybody, like it's me, you, Steve, Amit. It's just like, we could be like, Matt, what are your thoughts on XYZ? And like, I give my 2-minute synopsis on everything. And it's like, it eliminates a lot of backlog of questions, because somebody might not have heard me just give that explanation to that guy 10 minutes ago.
That's exactly right. I was talking to someone about Venture Global, and then another person asked me about it, and another person asked me about it. And I was like, man, I've repeated myself like 5 times already. Like, I just didn't want to talk about it anymore.
Well, I don't mind repeating, but like my hope is that I can get deeper conversations to really help shape people, right? Like Venture, like asking about one particular stock like Venture Global, it's great. I that's partly why I'm there. But at the same time, it's like, if I can help instill any sort of wisdom to help them get up the learning curve, which has always been the reason why I do these YouTube videos, all that is, that's more beneficial to me than like one individual stock where, that might make you a little bit of money, but I'm trying to like foundationally help like your investment thesis and how you look at the world of investment rather than one particular stock. Like you're bigger than one stock.
But then there's also like some people want like an entire guided process on how I look at companies, and I'm like, it takes time, you know. It's one of those things that you develop, and I'm not sure I can explain everything in like a 5-minute sit down. You know what I mean? It's hard. It's just really hard. So I don't know.
I was complaining about the time because it's from 6 to 12 on Saturday. And that means it's really 9 to 3 a.m. my time. So
why is it 6 to 12?
Because it's on a Saturday, not a Sunday. So Amit's doing it in the evening.
Got it.
And I was like, I don't know how the hell I'm staying up till 3 in the morning.
I just want to come to hang out with you guys. I'm not really like too keen on chilling with everyone else. I just want to hang out with the boys. That's about it. You know, does that make sense? Like, it's great that it's like a meetup, but I just want to hang out with you guys.
That's what Friday's for.
Yeah, exactly.
When are you flying in?
Thursday.
You're flying in? Maybe I'll fly in Thursday.
Thursday afternoon, I'm flying in, and then Friday I'll be with you guys. Yeah.
Yeah, maybe I'll fly in Thursday instead of Friday. And Chels, I think the Chicago one's going to be on Saturday also. I'll ask him and let you know.
I like that. The last 3 hours, we should find a fireplace and Steve can.
It's California. I don't think they've ever seen a fireplace.
Unless
it's a mountain that's on fire.
They're not allowed to have them anymore.
Yeah. Yeah.
True.
Yeah, LA is going to be cool. Chicago is going to be cool. I'm looking forward to those. I'm looking forward to Miami. Miami will be interesting. There's a group of guys I met at the NY one that I am looking forward to hanging out with in Miami.
But do you want to call anyone in particular out?
No, because if I leave one of them out, we're in a group chat together. So,
am I in it, or should I just off myself?
Oh God! But yeah, it's gonna be good.
There's a lot of people, man. Like that's part of the reason why I do YouTube is like a lot of smart people, obviously, but then there's a lot of people that can contribute to the community that I continue to learn from as well. So as Steve alluded to, it's like there's a lot.
That was a joke, man. Someone's like, Chris is dumb. We have fire pits here. Duh, I know y'all have fire pits, man. That's a joke.
All right? They don't have water in California.
Yeah. All right.
Just kidding.
Guys, see ya.
Love you, Chris.
Later, Chris. All right, Matt. Well, you need to free up your schedule.
I have, you need to hire me first, Steve.
Talk about that in a couple months. See what happens. Let's just say there's gonna be some announcements coming.
Did I show you my dividend builder on probably.xyz?
No, you didn't. I want to show you some things that I built.
Cool, let's do that. Let's spend a little bit of time on that.
So
I need to get dinner at some point.
I'm a degenerate, and I built something that right now I have it searching my AI agents. So I'll show it in a minute.
Why does everyone say Chris needs to go do the dishes? I've seen like multiple people, and it's not the same person. I'm so confused.
Vibe coding show and tell.
Yeah.
I mean, it may.
I'm going through my entire user interface. What's that?
I said Matt's site came out really good, by the way.
Well, the thing that's nice about it is I'm taking a piece of advice from you, which is like, it's all piecemeal, right? I'll like one day I'll be like, oh, let me do 13 Fs. Another day I'm like, ooh, what about the portfolio builder? Then one day I'm like, let me build a live dashboard. Because of that, I don't want to say piecemeal, it somewhat flows. And if you like power your way through it, but because I build it like over the course of time, there's no like uniform thread. And so like you just kind of alluded to in some of what you've been doing, I said, hey, do a user interface auditor and give me all the things that you would do to make this more optimized, clean, and better user interface. Because obviously, at the end of the day, the way you do that keeps people on the site, one, which helps with ad revenue, two, but allows me to build more. And it's more so about building. And my hope is like, I'm not trying to make a lot of money on this. I just want it to be a useful tool for people. And so if like this thing starts printing money in ad revenue, I'll probably lower it to the lowest tier of ads. Like I don't want to, it already is on really low and none of the ads have showed up yet. Obviously I still need to get verified by Google. But like my goal isn't to like print money through advertising. Like my goal is to like make a useful site that people will use and really benefit from. And so I'm hoping that if that's the case and the costs to run the compute aren't that much, that I could keep it free. And that's kind of the thought. And I wouldn't mind adding a contributor section as well. So if people are like, holy crap, like I want to write an article about XYZ, then they can, and I potentially could share that ad revenue with them as well.
Well, I think your site came out good, and I built a prediction market arbitrage thing where you can click into it. And I know it's hard to see. I can't increase the size because I'm actually on Claude, not on a web browser. And you can click in. So like, hold on. So when does U.S. strikes Iran by? This one's already done. Chile presidential election, there's a 95% yes. So it gives me an edge detector, which I can click into, an ROI strategist, everything else. So you can build some pretty cool stuff on here. So it gives you the whole edge, and then everything else will come in. I was doing it for sports betting, but it was just, there's so much information out there. I need to figure out a better API to use. You can legitimately build anything you want with Claude.
I like it, Steve. Are you going to distribute these things to people or what? When are you going to actually?
No, they're for me.
You're withholding it from the people, Steve.
I'm selfish.
You are selfish. Look at me. I'm creating a tool that I've come out of pocket hundreds of dollars to be able to create.
Listen, I always say if I had your money, I'd donate mine. But no, in all seriousness, I am thinking about. I'm going to show everybody the newsletter thing I built. It's freaking great. I'm thinking about putting something together for members only, where I send out an email every day to them with a briefing. Not from me, but from this. It is so good. Let me show everybody what I did. And in the chat, if you're a member of my YouTube channel, let me know if you'd want an email every day with just like economic and market analysis. I will consider doing that. So this is what I built. So I have a chief economist agent, a political agent, or a political analyst, a stock market strategist, an earnings intelligence agent, the forward calendar, income and dividends agent, and then I have all 6 of them working independently. I have fact checking built in. Then they send all their information to my 7th agent, which is a data verification agent that data checks everything. And then once agent 7 is done, everything goes to my 8th agent, which is an editor in chief, and it builds out a full newsletter. A lot of people are saying yes. Interesting.
Yes to what, Steve?
Oh, Rambler's got jokes. And listen, I did not name it the Amit replacement. This is not replacing Amit, even though he said it is. Oh my God.
Notice how it's
Yes,
called the alpha angle.
the alpha angle, yeah.
A for Amit.
No, come
Replacement?
on. Not trying to replace Amit.
Conspiracy. I
It's
think
not
not.
conspiracy. I wanted something that I could read.
You're
when I
right. It's
drink
not a
my
conspiracy.
coffee in
It's
the
an
morning.
actual thing that you're trying to do. I'm just kidding.
Not. Look, this is what it looks like. The alpha angle. Nice professional newsletter. You can click on the link. It'll bring you right to it. We got just an overview. We have the economic polls, policy and politics, market overview, global markets, earnings watch, bonds and rates, energy, technology and AI, financials, communications, crypto and digital assets, income corner, week ahead, technical picture, key levels, risk radar, and the bottom line. So I have this generated for me twice a day. I read it in the morning while I have my coffee, and then I skim through the evening edition. So AI has no soul. Exactly, Chris. This is never replacing anybody. It is strictly a briefing for myself. That's all it is. So if people are really interested, I will figure out a way to have this automatically sent at some point.
I like it, Steve. Steve, do you think
Information's
you're a
pretty good on
billionaire hedge fund manager?
No, I am not.
Okay. Rick, apparently Steve doesn't think that.
No. I mean, nothing can replace a man drinking instant coffee.
I did like how we had an instant coffee with Amit the other day. I thought that was pretty funny.
Which is freaking disgusting.
I'm not the biggest fan, but
instant coffee is disgusting. Whoa, Rusty. Rusty, I write more for Seeking Alpha than 99.9% of their people. This week was a little light. I had my real job cut into it. I had a lot of shit going on this week. I think I only did 3 articles. But hey, there's an article coming out tomorrow. There's an article coming out Monday. There will be an article Tuesday, probably Wednesday. I think there'll be one a day this week.
Steve, what else are we buying?
You know, I'm really interested in freaking Oracle. I want to see them go down. I want
to see them go down.
I want a better entry point. I'm selfish.
Okay.
The real question is, what time would you like to do the small portfolio update tomorrow?
That's a good question.
I need to know these things.
I'm available all day. Preferably not before noon.
9 a.m. it is.
I mean, if you really need to, then I'll go to sleep now.
I know you like to sleep in. I get it.
Well, I still need to eat, and I don't want to go to bed, until my stomach has a little bit of...
I get it. So let's say 3 o'clock.
I'm a sleepy baby. Yeah.
So 3 o'clock tomorrow, we will do our small portfolio update.
And if somebody just asked me in the chat what I thought about Rocket Lab and its downside, I think probably XYZ does a really good job explaining the downside. So if you go to there and go to the forecast or analysis tool, it gives a really good estimate of what the downside could be, which is less than it is today, right? It could go down in price. And so gives really good reasoning for that.
Rachel, I do not have Dutch Bros near me.
No, not yet.
No, I do not. It's true.
What does it say? Steve, I want to show you this dividend builder. I want you to...
Yes, I want to see it. So we're going to end on the dividend builder. I know Chel's asked about it. Let's see it.
Oh, did she? Where?
She asked something about dividends.
Go to probably.xyz, Steve. I want you to build it on your own.
No, I want you to do it.
No, let's do it. I want to see how easy it is and intuitive.
All right. What is it again?
Probably with an I instead of a Y. .xyz.
All right, so I'm definitely spelling it wrong because I don't have the link to click on it. What is it? How I spell it? PR.
Instead of with a Y, it's with an I.
I'm not that smart, Matt. Tell me how to spell it.
PROB
Yes. Yes.
ALI dot XYZ.
And for those of you that are thinking, I went to his site on my phone and tablet because that's where I have WhatsApp, and that's where he sent me the link. It's not letting me go there, sir.
No www, just probably.
PROBALI.
Oh, you forgot the second B. BLI.
Yes, I did. I can't spell. Maybe you forgot it.
I might have said it wrong. Yeah.
You probably said it wrong.
I don't even know my own website, Steve.
All right. Where am I
So go
going?
to the upper right. And I need to fix the user interface a little bit, but go to the upper right, go to Builder. And then there's the actuals thing up top. So that's a like kind of a forecasting feature I'm trying to build in here. But if you go to actuals, which I need to work on the naming and stuff like that, you can start adding in holdings. And with that, you'll be able to -1. Oh, okay. And then go to fetch prices, or just add multiple things and then do fetch prices, etc. There's some monthly boys in there.
We're gonna have 5 stocks. Hold on.
Things that have different monthly pay dates, which you know a lot about. So
Yeah, I'm putting it in there. What the fuck?
It's limited to 3. Why does it say free accounts? Everything's free. I need to fix that. But go to fetch prices now.
Okay.
And then it should, if you scroll down, see a lot of stuff. When it's supposed to be paying. They scroll down again. There's probably more, right? Or do you have to sign into an account?
No, there's more.
See, there's.
No, this is cool. Definitely really cool. Dividend payment calendar. How much income's coming in. And you built all this on Replit?
Yeah. I mean, not
Very
easily.
cool.
But the thing that's nice about it, Steve, is like, as you and I like to do, right? Like, if you're a dividend investor, you know the big thing is like, when are you getting paid? That's part of it. 2, you want to see, well, what if I reinvest these dividends? Like, what's it going to look like next year? Well, you can do reinvest or not, right? Or you could select which ones you want to reinvest. Say you want to continue to increase position, or say you have one that you want to basically just like harvest from, right? Not reinvest, but so you can toggle on and off which ones, and all that's in some of the sign up free kind of hidden stuff. But then there's also the how much additional money do you want to invest? Let's say it's 500, 1,000, etc. a month. The thing that's limiting about that is like it only goes into the current allocation. So like what I want to potentially do is have like a sliding scale, like how much of that money goes into, let's say, ET for you or for Enbridge or etc. But my hope is then you can be like understanding how you could potentially grow. The thing that I'm using this for and hoping that people use this for, it goes back to what we started the show with, right? Is I want people to be like, a lot of times, and this is the whole premise of why I made this website. I have so many people that come up to me and they're like, oh, but you think I can get to my goals, right? And I'm like, you're being unrealistic, right? Like you need to be more realistic. And so what I want people to do is realize that, hey, you might be getting someplace and based off of your current assumptions, but like you really need to hyper focus on and actually put a plan together to get to where you want to go. And I think a lot of times people are just shooting from the hip. And so somebody might just sit there and be like, I need $50,000 a year in dividend income and blah, 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 blah. It's just like, well, based off your current portfolio, like you need to do better, right? Like you need to hold yourself more accountable. Don't point the finger at the market. The market can only do so much, right? And so it's the same thing with what I hope to do with the portfolio builder, the on earlier tab that we clicked away from, which is like, I'm going to get to a $2 million portfolio. It's like, well, Bill, you're starting at $1,000. Like, you can't go from 1,000 to 2 million, or very rarely will somebody be able to do that by picking individual stocks. And so my thought process is like, well, then if you were able to have a probabilistic distribution or ensemble model that allows you to kind of understand, well, on a generally P30 case, I should be able to meet my objectives with where I am today, or I need to get more aggressive about adding. Maybe instead of adding $100 a month, I should be adding 150. It gives you that opportunity to then say, okay, I need to do better. I can't just assume that the market's going to return me a $1 billion, whatchamacallit, every single year. So, yeah.
I like it, Matt. I think everybody should sign up for this.
And as it is, it's free. So right now there's no ads at the moment. There's placements for it, but Google hasn't approved it yet. So fingers crossed that we get there, and hopefully it can stay that way. Otherwise, I'll have to figure out a way to charge people a minimal amount of money. And I might make an ad-free version as well if people want to do that as well. What do you think, Steve? You gonna make an account and build out your portfolio? Use some of those charts for your fancy weekly report that you do?
Maybe I will. Maybe I will, sir.
No, you have such a good Excel sheet too. So
my Excel sheet is ridiculous.
I love it. I love it.
Ridiculous.
If I had Steve's money, I'd be building stuff on Claude too.
I spent less on Claude than you spent on Replit, just so you know.
Well, I'm not trying to wait until, like, no offense to you or to Tevis, but maybe doing it through Claude would have been better. But at the same time, I'm not trying to wait like 6 hours until I'm able to do something.
You don't have to. We both have the enterprise plan.
Oh yeah, yours is like 200 or whatever.
I upgrade.
You don't run out of tokens?
No. On the $20 plan I did, I'm like, fuck this, I'm not waiting.
Yeah, maybe I should update to the highest plan with Replit.
I think you should.
Maybe I would have saved money.
I mean, I think you did a good job on it.
I appreciate that, and hopefully it helps some people out. Even if it ends up being I just develop it and I just break even on the server costs, etc., which it shouldn't be that much money. So hopefully, once it's up and done. But like, my problem is I just keep wanting to perfect it and build it and polish it, and like that's what's costing the money.
What happens?
So what I might do is at some point I might just say, you know what, this is good enough, and I think I'm getting to that place. And I'll be like, if there's any updates, I'll write them down. If people have thoughts, and unless it's really a big deal, then I probably won't get it. Probably, I probably won't do any. I'll do like monthly pushes of stuff, but I won't do it like out of pocket. It'll be kind of on like maintenance mode.
Matt, my little dividend project on Seeking Alpha.
Yeah.
Starting to get ridiculous.
Do you want to tell people the stat you told me or no? You told me that. I felt like in confidence. So
what's that?
Well, I mean, I think people can like how much you're making off of it and how it's like, you know what I mean?
I mean, look, it pays for itself.
There you go.
So
pretty cool.
Check this stat out. So for those of you that are unaware, I have a weekly series I've been writing for like 4 or 5 years now. And I put $100 a week into income producing stocks. And this is a chart of the monthly income each month, year over year. February just went from $143.71 last February to $213.10.
Insanity.
And I mean, this is on $100 a week. Look, for some people, this is a lot. For some people, this is pennies. There's about 30.
I think it's a good medium ground, Steve.
Like 35 grand in here now. So I'll show you the P&L. But I think this is really interesting because I do think I'm going to crack 1 month of $300 income in this. And just after the first week in March, I've already generated 35.5% of March 2024's income.
Insane.
Check this out.
You know what I'm so excited for? Because I did it in my own portfolio, and it like this is back when I used to be a dividend investor. Hitting that $1,000 a month mark was like. Anyway, sorry to cut you off.
No, I'm with you. Mo has generated. I have not added shares of Mo since February 2023. It's still the number one holding, and I don't allow anything to get past 5%. It's generated just over 31% of the initial investment in dividends.
I like Mo.
I like Mo too.
I used to follow it it used to be my number one stock at one point back when I was a dividend investor. And I don't know. I'm pretty sad. You know, it'd be kind of cool to have kept up with it. But I guess my question is for Mo. Are they continuing to diversify into like wines and other things? Or are they
Not really.
strictly
Tobacco? So here's the last one I'll show. So this is the P&L. The red line is the portfolio value. The blue line is invested income, and the yellow line is the dividends. I've invested $26,200 into this. The goal has never been to beat the market or replicate. It's been to mitigate downside risk and to generate recurring income. When I look at the P&L, and I'll zoom into this, the Ukraine-Russia war was the only time it really dipped, and it didn't even dip for that long. It has stayed really close to the blue line, and now it has been over the blue line for quite some time. This thing is generating off of a $26,200 investment. The account value is basically 36 grand, and the annual projected dividend income is up to $2,839. 7.89% yield. And there's 103 positions in the portfolio. It's my own ETF. And I have a bunch of closed-end funds, a bunch of ETFs in here. It's interesting.
That's why they pay the big bucks, Steve. And somebody said $1,000 a month in dividends is a lot at my age. I don't know if I do anymore. Do I still? No, I just crossed over $1,000 a month. At one point, I was about to approach 2.5, going on 3,000 a month in dividends a couple years back, but then I changed my strategy a good bit, and obviously it's paid off well in total net worth gain. And that was kind of the thought process. It was like I was kind of doing what Steve was talking about, that very regular, have a steady dividend portfolio that didn't really care about the total appreciation, but cared about what the cash flow looked like. And I don't want to say bored, but I had kind of realized like I could see where I was headed, and I was like, I'm going to get to my goals faster than I want to. Let's play Monopoly pretty much. And so that's where I'm at today with respect to being like, oh, well, let me see if I can get to the 8 figures, you know? And so like, it was just like, oh yeah, of course I could have just steadily added and got to my point, but it was like, okay, I'd get to the point where I am today was based off my calculations in like 4 or 5 years. I was like, I'll be making X amount in dividends a year. Like, why, if I could do so much more with the potential that I have, why not try it? Right. It was almost like a game for myself to kind of challenge myself. And Steve, I mean, you could probably attest to it, you know, about my life a little bit. Like it's done pretty well.
Listen, if I had your money, I'd donate mine.
Fucking Steve. Hey, I need your help.
Up to it.
I need your help. What am I getting for dividends, Steve?
Well, it's a little late. Your options are probably limited.
Probably. I did have a Dutch Bros sausage slider, so that's like a couple hundred calories. I have to see how much that was. So we'll see.
But I do want to answer 2 questions real quick. So Rachel, I am familiar with it a little bit.
Familiar with
I
what?
put in the chat, I am in SPYG, which is State Street's growth of the S&P 500 companies. I like it. So that's the one I'm in. And then I did not write about Qualcomm yet. Probably tomorrow. Got caught up with a few things today.
Steve thinks it's better than us.
You think you're better than us, Matt?
I am.
I mean, only on days end and why.
So somebody asked, what did I think? The food products that I have had of the expanded menu have been really good. The cake pop, which I had, I think, last Saturday, I remember bringing that on the show. That was like, holy crap. The sausage slider was really good. The thing that's nice about it, specifically for somebody like myself who's trying to like make sure like a lot of the food items are going to be less calorie intensive than some of the potential drink options. But I had the sausage slider. I don't know how many calories it is, but rather small. So it's not like you're eating like a big, massive fast food meal. It's nice, quick, and kind of kept me going until now. Otherwise, I'd be very hangry and yelling at Steve, and nobody wants that. That just doesn't show up well to what's the optics. So yeah.
All right. So why don't we end it there then?
Somebody asked me about Symbotic, Steve. I'm sorry, gentlemen. I keep forgetting to mention it. I like Symbotics. I'm buying. I bought more on Monday. I'll probably continue to add. I wouldn't be surprised because it's such a small part of my portfolio that if I get paid a bonus, that bonus might go to buying another house.
What type of bonus is that?
I mean, you gotta get down payment, Steve.
Listen, this is why I say I don't know why you think I'm joking. If I had your money, I'd donate mine.
So adding, I don't know. It depends. If I end up deciding to just say screw it and buy more stock, which sometimes is something I do because I like buying stocks, I might do catch ups on Symbotic, especially down if it gets way into like the 40s. I'm not running out and backing up the truck here at $50, but it's appetizing, and I wouldn't mind getting it closer to the cost basis, which I have like Next Decade and Venture Global. Because I think it could be one of those ones where I could easily see it potentially being a $250-300 billion company, and that alone would be a potential 8 or 9x before they do any sort of buybacks, hopefully. So
I like it. All right, everyone. I think we're going to get going. We're going to call it a night. We got the main event coming up soon. Matt's got to get dinner. And we got to get prepared for tomorrow. Small account challenge at 3 p.m.
Oh, a little ramen.
Michelle is showing off again.
Thank you for everybody being here. It's really a true pleasure to have an opportunity to talk stocks and riff off of people to get their thoughts. And it's really a privilege that I've been able to build over the past decade. And it's nice that I've met somebody like Steve, who I wouldn't have met if I didn't do YouTube, and who I wouldn't have met if I wasn't on X. And so excited and appreciate the listeners on Spotify and Apple Podcasts and everybody else that's tuning in here on Twitch, etc. So we're very much appreciated. It's a pleasure to be here and a privilege.
Yeah, very grateful for the community, and there's going to be some announcements coming up. Can't say what they are.
You going to tell me off stream, Steve, or is it stuff that I already know?
No, you know. But there, in the next couple of weeks, there's going to be some announcements coming up. That's all I can say right now. Tight-lipped.
There's no better kind, Steve.
No better time than right now, right?
No better kind, but either way, no better time. The time is now.
Thank you, everybody, for being here. Really appreciate it. Michelle, really glad to have met you guys. See you in California. We're annoyed Matty can't come, but he's got other obligations.
I'll be on the beach with my fam.
You know, some would say you can be in two places at once.
If it was just me, then yes. But
some would say you could just fly in for a day.
I'm not gonna subsidize. No. I was gonna say, I'm not gonna subsidize like 5 people traveling to LA and housing them. But
I mean, anyway, all right, everyone. Have a great night. We'll see everybody at 3 p.m. tomorrow. Thank you very much.
2 p.m. Central. Love you.
No, 3 p.m. Eastern. What are you doing?
2 p.m. Central.
You said 3 p.m. Central.
I said 2 p.m. Central.
Oh, maybe I'm just hearing things. All right. See everyone later. Have a great rest of the night.
Business trips.